Cool. So Carter and I are going to go into what's called the net loss harvesting strategy. I came up with this morning. It's just something I've been doing for years. And this applies directly to those real estate investors that are looking to transition from their small portfolio out of it because that stuff pays you chump change. But the thing is that the big great fear is that you have to pay taxes or do a 1031 exchange to sell those properties.
Right.
And with this strategy, it does require some patience and also some planning. But if you do it, you can increase the liquidity in your balance sheet, which banks are going to look for as you start doing 10, 15, $20 million deals, and also be able to get out of those properties that don't make you any money because you've awakened to the new reality of owning commercial property. And so it kind of goes like this. I mentioned that I have a $200,000 yearly loss on just one of my partnerships alone. It's a building that we've been redeveloping. It's not necessarily costing me $200,000 out of pocket each year to hold this investment. We're getting paper losses due to this being a major redevelopment. We're using strategies like cost segregation analysis and also accelerated depreciation on this deal. I take a look at what net losses that I have, and then I talk to my CPA and I'm like, hey, what's a property I can sell this year and be able to harvest that loss? Because net loss carry forwards, like you can carry forward them year after year and keep banking them up. At some point in time, it's advantageous to harvest those losses by selling smaller properties in your portfolio. And you can do this. Like last year, I sold a property at a $200,000 gain on and was able to sell it tax-free. I didn't have to do a 1031 exchange. 1031 exchanges are like a gun against your head when you're looking to sell a property, then find a replacement property. The timelines are absolutely ridiculous. You have 180 days to close in a new property. And we all know when we're out there looking for unicorns, that are investment deals, even in commercial real estate, it can take time to do that. And I've seen investors being party to 1031 exchange transactions because I was also a former real estate broker, buyers making very dumb decisions, just letting the tax tail wag the dog in what their investments are, instead of buying a mediocre deal that ends up being a bad investment anyways.
Nice.
Step by step, what you want to do is take a look at your tax returns, actually set up a tax planning session with your CPA, and then look at what are my net loss carry forwards. Now, this is going to require you to buy bigger deals first before you start selling smaller deals. So you are going to buy a bigger deal, find out what types of tax strategies you can apply to that deal and how much losses you can generate for it, and then talk to your CPA, hey, let's identify these properties on my Schedule E and figure out which ones to transition out of and put some cash in the balance sheet through these sales. So this does take time. This does take maybe 2 to 3 years to do this, but next year we're probably gonna have about $500,000 in paper losses that we have banked up. So the sale that I sold this year has about a $500,000 gain. So I'm able to actually just harvest that loss and transition out of all of these assets that I started buying in 2006 and be a pure play, bigger commercial deals without having to pay the tax man out the nose in the process.
Quick question. When you say your deal next year is going to have $500,000 in paper losses, what does that mean? Is that like depreciation? Like what does that entail?
Yeah, depreciation. Primarily. There's a building that we acquired a couple years ago we're going to be redeveloping. It's going to be about a $25 million project to redevelop this building. So that is going to generate a lot of losses based upon that turnaround. So this is going to allow me to have the perfect opportunity to then, okay, now all these old assets that I had that I was buying between 2006 and 2013, for instance, I was like, now I can shed those and I can actually build up my cash and cash equivalents in my balance sheet.
Okay. That means depreciation, which your CPA can then take and use to offset the capital gains on the sale of those smaller assets, which is that's the strategy, which is nice.
Yeah. And that's the typical dilemma is that you have, real estate is great because it's very, very tax efficient. If you're structuring your deals right and buying good, desirable properties, that yearly income is usually going to be offset by the depreciation on the asset, right? So just take that, apply it to a different order of magnitude with larger deals. And so you're going to basically be able to 10x the depreciation losses on the larger deals you do acquire and then fully transition out of the small chump change properties.
Yeah. That's actually crazy. That's the benefit of going bigger,
Absolutely.
So, love it. Okay.
Well, absolutely. If you enjoyed this, I hope you got some value out of it. We've been trying a new format right here in studio here. So definitely make sure to comment any questions you have. We'll put together another training video on this to answer your questions, to keep putting that value out there. So make sure to comment, and also subscribe to our channel to be in tune for more. And also our podcast, Go Big Live, have to give a shout out for that. So thanks for being my guinea pig, Carter. I appreciate it.
Love doing it.